Hi, my name is Hank, your host at Global Finance Mindset. Prologue. What you are about to hear is not a prediction. It is not a theory. It is not the breathless speculation of a talking head chasing clicks on a slow news day. What you are about to hear is a map, drawn in real time, in blood and oil and data, of exactly where the world is right now, where it is going next, and precisely what you need to do to ensure that when this era resolves itself, you are standing on the right side of history, with your wealth intact and multiplied. Because here is the ugly truth that no one on mainstream television will say out loud. The greatest wealth transfer of your lifetime is happening right now. Not next year, not next decade, now. While most people are staring at their phones in paralytic fear, watching oil prices scroll red across the bottom of their screens and wondering whether to sell everything, a small group of cold-eyed, disciplined investors is doing the exact opposite. Loading up, buying in, and positioning themselves for a return that will look, in 5 years from now, almost obscenely obvious. The question is, which side are you on? Buckle in. Part 1. The fire that lights the fuse. It began without warning, as the most consequential events always do. One morning the world woke up to a Middle East that had crossed a threshold. The United States, in a coordinated operation alongside Israel, struck targets inside Iran. Within hours, West Texas Intermediate crude oil spiked from roughly $67 a barrel to over $77. The Dow fell nearly 900 points at its intraday low. The VIX, the so-called fear gauge of the financial world, spiked sharply. Airlines lost billions in market capitalization before lunchtime. And then something curious happened. The market bounced back. By the close of that first trading session, the S&P 500 had erased nearly all of its losses. Tech stocks surged. Defense stocks exploded. Lockheed Martin up more than 5%. Northrop Grumman up 6%. And one company, a data analytics and artificial intelligence firm that the financial media had spent years dismissing as overvalued, rose 15% in a single week. More on that company in a moment. The lesson written in those numbers is one of the oldest in market history. Markets do not react to events, they react to expectations. And the investors who truly understood what was happening, who had prepared, not predicted, saw something very different from everyone else. They did not see a catastrophe. They saw a catalyst. Part 2. The graveyard of emotional investors. Let me paint you a picture you have probably lived through more than once. A crisis erupts. The headlines go red. Social media erupts. Pundits circulate catastrophic narratives in an enormous echo chamber until the noise is deafening. Fear compounds fear. And then, ordinary investors do the single most destructive thing they can possibly do. They sell. They sell near the bottom, because the emotional breaking point comes just before the actual floor. They exhale with relief, feeling briefly rational. And then the market turns, and they watch in horror as it rises without them, until the pain of being left behind becomes so unbearable that they buy back in near the top. This is not a character flaw. This is human psychology meeting markets that are specifically designed to punish emotional decision-making. Research examining every armed conflict since World War II found that the S&P 500 was higher 1 year after the onset of conflict in roughly 70% of cases, with average 1-year returns sitting in the high single digits. Consider September 11, 2001. The S&P 500 dropped approximately 11% in the first week of trading. Within roughly 1 month, the market had recovered those losses entirely. Consider Russia's invasion of Ukraine in February 2022, an initial sharp equity decline that, for investors who stayed the course, gave way to recovery within the normal cycle. The pattern is consistent to the point of being almost boring. And yet every single time it plays out, approximately 90% of retail investors manage to be standing in the wrong place when the music stops. JP Morgan Asset Management has quantified this destruction with brutal precision. An investor who placed $10,000 in the S&P 500 in January 2000 and left it untouched for 20 years walked away with over $60,000. An investor who made the same initial investment but missed the 10 single best trading days over that 20-year span, just 10 days out of roughly 5,000, walked away with less than half as much. Vanguard's own analysis, tracking a hypothetical $100,000 portfolio from 1988 through 2024, found that missing just 10 of the market's best days over that period would have cost an investor $2.6 million, a difference of 52%. And here is the detail that makes this statistic genuinely chilling. According to JP Morgan's research, 7 of the 10 best trading days in any given 20-year period occur within 2 weeks of the 10 worst days. The best days and the worst days are neighbors. If you flee the market to escape the worst, you almost inevitably miss the best. You cannot have one without the other. Part 3. Reading the smoke signals. Not all crises are equal. The signals embedded in the market's reaction to this particular conflict are, if you know how to read them, almost shockingly clear. The first signal is in the oil price itself. Crude moved from roughly $67 to the high 70s, significant but contained. Compare that to the 1973 Arab oil embargo, which triggered a 50% plus multi-year spike and contributed to a decade of stagflation. Or compare it to 1990, when Iraq's invasion of Kuwait sent Brent crude soaring more than 70% in a matter of months. Goldman Sachs noted that a sustained $10 per barrel increase in oil would reduce GDP growth by approximately 10 basis points. Meaningful, but far from recessionary. The market's resilience reflected institutional investors reading this distinction in real time. The second signal is in where money moved. In the hours after the first strikes, professional money rotated out of airlines, consumer discretionary, and energy-intensive sectors, and into defense contractors, energy producers, and most critically, the AI and technology companies driving the secular bull market of this decade. NVIDIA and Microsoft were bought heavily on the first day of the war, not because technology consumes oil, but because the investors with the longest horizons understood something else entirely. This conflict is fundamentally accelerative for American technology dominance. The AI revolution does not pause for wars. If anything, it accelerates. Part 4. The company built for this moment. There is a company that most of Wall Street spent years trying to dismiss. Its name is Palantir Technologies. And in the first week of the Iran conflict, while the broader market stumbled, Palantir's stock rose 15%. Palantir was founded to build software that could process vast quantities of disparate data into actionable intelligence, in real time, under conditions of extreme uncertainty. Their first customers were the intelligence agencies of the United States government. Fast forward to 2026. Palantir has reported fourth-quarter revenue growth of 70% year-over-year, with U.S. commercial revenue surging 137%. Its adjusted operating margin hit 57%. Management has guided for full-year 2026 revenue of approximately $7.19 billion. The company holds $7.2 billion in cash with zero net debt. Then the war came. Palantir's tools, its Gotham intelligence platform, its Maven smart system providing AI-powered weapons targeting, were reportedly deployed in the Iran operations. Overnight, every defense procurement officer in every allied nation and every CEO suddenly studying the world map with new anxiety became a potential Palantir customer. Analysts raised price targets to $200 and $230. The highest target on the street sits at $260, implying more than 65% upside from recent levels. Palantir is not a defense company that happens to use software. It is a software company that happens to be indispensable to defense, intelligence, and increasingly commercial enterprise. It is built for exactly the world we are living in. A world of geopolitical chaos, accelerating AI adoption, and a race by governments and corporations to make better decisions faster than their adversaries. Part 5. the AI revolution, and the survivors. There is a narrative circulating that artificial intelligence is going to destroy the software industry, that AI will make software engineers obsolete and wipe the entire enterprise software category from the economic map. This narrative contains one sliver of truth wrapped in an enormous lie. The truth: many software companies will not survive the AI revolution. Businesses built on solving problems that AI can now solve more cheaply are facing genuine existential pressure. The lie: that this applies to all software companies equally. Consider the dot-com era of 1999 to 2001. 95% of internet companies were obliterated. The Nasdaq lost nearly 80% of its value. And then, from the rubble, emerged a handful of companies, Amazon, Google, Salesforce, that went on to define the next 3 decades of economic life. The survivors did not merely survive. They compounded into multi-trillion-dollar enterprises that restructured the global economy in their image. The AI revolution is following an identical template. Roughly 80% of today's software landscape will be disrupted or eliminated. The 20% that remain, companies with genuine intellectual property moats, sticky distribution, vertical integration, and the ability to work with AI rather than against it, will become the Amazons and Googles of the next era. Google is instructive. Rather than continuing to buy NVIDIA's graphics processing units for every workload, Google developed its own custom silicon, tensor processing units, built from the ground up to run AI at a fraction of the cost. Google Cloud is now growing at roughly 50% annually. The company is not being disrupted by AI, it is being supercharged by it. Part 6. The 20 that matter. The following 20 companies represent, in my assessment, the highest conviction opportunities for a long-term investor navigating the current environment. They share genuine intellectual property moats, sticky distribution, vertical integration, and the ability to work with AI rather than against it. Palantir Technologies. Built for war, built for peace, built for chaos and prosperity. With government and commercial revenue accelerating simultaneously and its tools deployed in current operations, Palantir is the most immediate beneficiary of this moment. Tesla. Quietly becoming the most vertically integrated robotics company in the Western world. Humanoid robots are a great secular growth trend, and Tesla's integration of battery technology, vision-based AI, motor engineering, manufacturing scale, and supply chain depth gives it advantages no competitor has replicated. Alphabet. Vertical integration through custom TPU silicon. Google Cloud growing at 50% annually. A search franchise evolving rather than dying. DeepMind producing world-class AI research. NVIDIA, the default building block of the AI revolution. Its CUDA software ecosystem creates switching costs that make its competitive position extraordinarily durable. Demand continues to outpace supply by a significant margin. Amazon. AWS remains the largest cloud infrastructure provider on the planet. As AI workloads grow exponentially, demand for cloud computing scales with them. Years of stock underperformance despite dominant fundamentals represent an attractive entry point for patient investors. Microsoft. Azure Cloud growing strongly. Deep integration of OpenAI technology across Office, Teams, and GitHub Copilot embeds AI into products used by hundreds of millions of people daily, a monetization pathway of profound scale. Oracle. The database is not going away. Data is the substrate of AI, and Oracle's strategy of migrating legacy enterprise clients onto its own cloud infrastructure, controlling both hardware and software, is vertical integration at its most powerful. Taiwan Semiconductor Manufacturing Company. TSMC fabricates the most advanced semiconductors in the world. There is no credible alternative at the leading edge. It is a global monopoly in the most strategically critical industrial process of the 21st century. Arista Networks. Connectivity is the plumbing of the AI revolution, invisible, unglamorous, and absolutely essential. As AI workloads increase, the volume of data that must move between servers and across the internet grows exponentially. Arista builds the high-speed networking equipment that makes this possible. Advanced micro devices. The GPU market is not winner-take-all. AMD is a credible, growing alternative with a strong product roadmap and relationships with major cloud providers who prefer not to depend on a single supplier. The total addressable market is large enough for multiple winners. CrowdStrike and Zscaler. Cybersecurity is not optional in a world of escalating geopolitical conflict and AI-accelerated cyber attacks. Both represent dominant paradigms in enterprise security, and as the threat landscape intensifies, their revenue growth accelerates with it. ASML Holding manufactures the extreme ultraviolet lithography machines required to produce advanced semiconductors. They are the only company on Earth that can do this at scale. ASML does not have a moat. It is the moat. Constellation Energy and Vertiv Holdings. AI requires enormous quantities of electricity. Data centers powering large language models are among the most energy-intensive buildings ever constructed. Constellation Energy, as a leading producer of carbon-free nuclear power, is positioned to meet this demand. Vertiv manufactures the thermal management and power conditioning equipment inside those data centers. They are the picks and shovels of the AI build-out. Datadog, the nervous system of modern software infrastructure. As AI systems become more deeply embedded in business operations, the need to observe and measure what those systems are doing in real time becomes more critical. Datadog has built the dominant platform for this. MongoDB. Data is the fuel of AI. MongoDB builds the flexible, scalable database infrastructure that AI-native applications increasingly rely on, better suited to the unstructured data formats AI systems consume than traditional relational databases. Cadence Design Systems and ARM Holdings. Both operate at the deepest level of the semiconductor stack. Cadence's design automation software is used by virtually every semiconductor company in the world. ARM's chip architecture, licensed to hundreds of designers from Apple to NVIDIA to Qualcomm, powers a significant fraction of all computing devices on Earth. As AI demands increasingly specialized, power-efficient designs, both companies benefit from every fabrication run in the industry. And 20th, Strategy, the company formerly known as MicroStrategy, through its STRC preferred share instrument. Strategy has reinvented itself as the world's largest corporate Bitcoin treasury company, holding over 720,000 Bitcoin on its balance sheet. Its STRC instrument, the variable rate series, a perpetual preferred stock, pays a floating dividend currently set at approximately 11.25 to 11.5% annually, distributed monthly in cash. For investors seeking yield and indirect exposure to Bitcoin's long-term thesis without the full volatility of the underlying asset, STRC offers a genuinely novel income proposition. As a component of a diversified portfolio, its yield profile is compelling in an environment of compressed returns. Part 7. The system that removes fear from the equation. Let me now show you the mechanism that turns everything I have told you into action. Because knowledge without a system is just anxiety with better vocabulary. A bull market runs for years. Confidence builds. Then a trigger appears. A war, a pandemic, a crisis. Fear floods the system. 90% of retail investors do the math of terror and sell near the bottom. Professional money moves in the opposite direction. The market turns. A new bull market begins. Retail investors buy back in near the top. The wealth transfer is complete. The antidote is a system so clear, so rule-bound, so pre-committed that emotion cannot gain a foothold. The first component, dollar cost averaging. You invest a fixed amount at fixed intervals, regardless of what the market is doing. Not when it feels right. Not when the headlines are calm. Always. When the market is down, your purchase buys more shares. When it is up, it buys fewer. Over time, your average cost migrates toward the low end of the historical range without requiring you to time a single thing correctly. The second component, concentration in quality. Dollar cost averaging only works if the companies you are averaging into have moats, cash flows, structural advantages, and long-term relevance that transcends any single crisis. Hype stocks, the manic depressive instruments that reach the sky and return to zero, will destroy this strategy. The 20 companies on this list were chosen precisely because they will still be here, and larger, a decade from now. The third component, time. A bull market historically lasts 4 to 5 years on average. A bear market lasts approximately 10 months. That means roughly 80% of all market time is spent in conditions favorable to equity holders. An investor who stays fully invested through all of it captures that 80%. The compounding does not care about your fear. It cares only about time and consistency. Part 8. 2 lessons from history. The COVID-19 crash of March 2020. On March 23rd of that year, the S&P 500 hit its pandemic low, a drop of approximately 34%. No vaccine existed, no treatment. The global economy had ground to a halt. Every human instinct screamed, "Get out, get to cash." Vanguard studied the portfolios of the top 1% of American investors during that period. What they found? 99% of those top portfolios did not sell. They held. And by the end of 2020, the market had risen 68% from its March low. The investors who sold at the bottom and bought back near the top lost half a year of one of the most powerful bull runs in market history, the dot-com collapse of 2000 to 2002. If you had invested in Amazon at its peak before the crash and held through the 90% drawdown that followed, through a period when Amazon's stock fell from over $100 to around $6, and if you had simply held, your investment is worth, as of today, many thousands of percent of what you put in. The crash was not the end of Amazon's story. It was the terrifying middle chapter that most investors could not survive long enough to see resolve. The AI revolution will create its own version of this story. There will be corrections. There will be moments of genuine doubt. And through all of it, the companies with genuine moats will compound their way to outcomes that, viewed from a decade out, will look inevitable. The question is not whether this happens. The question is whether you will be there to receive it. Part 9. The longer arc. The geopolitical realignment this conflict represents is not a blip. It is a structural shift with profound implications for the next decade. The rise of artificial intelligence is, at its core, an American story. The foundational research, the dominant companies, the most powerful models, the most capable chips, they are overwhelmingly concentrated in the United States. This conflict, whatever its ultimate resolution, accelerates that reality by forcing increased defense and intelligence spending and heightening demand for AI-powered decision tools. The technological race between America and its rivals is not an abstraction. It is the central contest of this century. And the post-conflict economic boost is a chapter that most analysts have not yet fully priced in. Every major conflict in modern history has been followed by a period of accelerated economic activity, reconstruction, rearming, restocking. The economic multiplier of post-conflict spending is well documented, and there is no reason to believe this cycle will be different. Add the secular tailwinds already in motion, the electrification of transportation, the build-out of AI infrastructure, the automation of manufacturing, and you have the conditions for a multi-year expansion that is more visible from a distance than it is from inside the storm. Closing thoughts. I hope you enjoyed this analysis. Please share it with the people you care about, family members, friends, colleagues staring at their screens right now wondering whether to panic. Because what you just heard has the power to be the difference between watching this era of transformation from the sidelines, impoverished by fear, and standing inside it with your wealth not just preserved, but compounded into something that changes the trajectory of your life. The fire is burning, the smoke is thick, but beneath the smoke, the foundation is being laid for the next great era of wealth creation. Be there for it. And before you go, I want to leave you with one question, not to answer out loud, just to sit with it. to let it settle into the quiet part of your mind where your real convictions live. 10 years from now, when you look back at this exact moment, at this war, at this oil spike, at this flood of red on the screens, and this panic in the headlines, what decision will you be most grateful you made?